All right, let's dive right in. Today, we're pulling back the curtain on the glittering and, let's be honest, often confusing world of UAE off-plan real estate. Now, it's a market with huge promise, no doubt, but also some pretty significant risks. Our goal here is to give you a professional's mindset to see right through the illusion, and it all starts with this one critical insight. This quote, man, it just hits the nail on the head, doesn't it? The feeling you get is that off-plan is some kind of golden ticket, an insider advantage. But what's really going on is often a carefully designed system where you, the buyer, are the one shouldering most of the uncertainty, not the developer. This is the core idea we're going to unpack today. So, first things first, let's really get into this off-plan illusion. When you sign that contract, what are you actually buying? You might think it's a future apartment, but it's more than that. You're buying a position in a very complex financial sequence. And trust me, understanding that sequence changes everything. Now, this is where it gets really, really interesting. There's this massive disconnect. As a buyer, you're conditioned to think the launch price is the fair market value. But for the developer, that price is just a tool. It's carefully calculated to generate buzz, create a feeling of scarcity, and most importantly, meet their cash flow targets to get the project off the ground. It's not about the unit's value. It's about their funding model. And of course, that leads us straight to the so-called easy payment plan. It's always marketed as a feature for you, right, to make it affordable. But in reality, it's a financial instrument for the developer. Think about it. A 60-40 plan means you are financing 60% of the construction. You are taking on the risk, allowing the developer to put in as little of their own cash as possible. It's a brilliant way for them to manage their risk. Okay, so you can see how this all builds into some very common and frankly, very dangerous myths. In this next section, we're going to tackle 4 key beliefs that lead so many investors down the wrong path. So get ready to have some of your biggest assumptions challenged. First up, the big one. This is the foundation for so many off-plan investments, the belief that you're automatically getting a discount compared to a finished property. But is that really true? So the myth is simple. Off-plan is always cheaper. The reality? Well, it's all about the math. An off-plan property is only cheaper if the market goes up enough during construction to cover all the risks you're taking, the cost of having your capital tied up for years, and any other fees. If the market stays flat or worse goes down, that so-called discount just vanishes into thin air. And this right here is the crucial point. In a lot of market conditions, buying a property that's already built, where you can physically see the quality, verify the actual rent, and sell it tomorrow if you need to, is often the much smarter, safer financial move. All right, let's tackle the next one, which totally plays on our fear of missing out. You know the feeling. If you don't get in on launch day, you've missed out on the best deal forever. But again, the reality is often the exact opposite of the hype. The earliest buyers don't necessarily get the best deal. What they get for sure is the highest risk. They're betting on a project that's just a drawing on a piece of paper. The best price? That often comes much, much later in the game. So here's the pro tip, right? The real opportunity might actually show up in phase 3 or 4. By then, the building is physically there, a lot of the initial risk is gone, and the developer is super motivated to sell those last few units to close out their books. That's when you have the leverage. On to myth number 3. This one feels so intuitive, doesn't it? Spreading out your payments over time, it seems safer, like you're protecting your capital. But are you really? The myth is that payment flexibility equals safety. The hard reality is that it only delays when the cash leaves your bank account. It does absolutely nothing to reduce your actual investment risk. What you really need to preserve your capital is flexibility to exit the deal, not just flexibility to pay. I mean, just picture this for a second. If the market turns against you, you could find yourself having paid 60% of the purchase price for a property that, by the time it's finished, is actually worth less than what you're legally obligated to pay in total. Your capital isn't preserved, it's completely trapped. And our final myth, the powerful allure of the new. The assumption that a shiny, brand new building will always, always be a better investment than an existing one. But here's the thing, new is not an investment strategy. A new project only does better if it offers something genuinely different in a market that actually needs more supply. If it's just another tower in an area that already has 5 other new towers, that new premium disappears really, really fast. And that's the bottom line you have to remember. Most new launches are just adding more of the same stuff to areas that might already be full. That new car smell wears off, but an oversupplied market can stick around for a long time. Okay, so we have thoroughly busted the myths. Now, let's switch gears. We've torn down the old way of thinking, so now let's build a new framework. How do you actually make smart, professional decisions? This section is your new toolkit. You know, the pros use a set of non-negotiable filters to size up a deal in just minutes. Is the project actually getting built? How does the price stack up against finished apartments right next door? How many other new buildings are coming up in the same area? What's the real rental demand today, not the fantasy numbers in the brochure? And most importantly, who is going to buy this for me when I want to sell? These questions cut through the marketing fluff instantly. And all of this leads to the final, and honestly, the most powerful tool of all. It's about shifting your mindset away from an emotional decision fueled by a slick sales event and toward a cold, hard, data-driven evaluation. It's about developing a scoring mindset. And this is exactly how you do it. You create a weighted decision matrix. It sounds complicated, but it's not. It's just a simple way to force yourself to focus on what truly drives a successful investment, not just the beautiful pictures and fancy promises. Let's just quickly break this down. Look at that. Developer reliability is weighted the highest, a whopping 30%. Why? Simple. Their track record is the single best predictor of your future. And checkout location, it's about actual existing infrastructure, not promises of what's coming soon. This is how you systematically take the risk out of your decision. Which brings us to the final, crucial question you have to ask yourself. After all the analysis, after running through the filters and the scorecard, what are you really investing in? Is it the tangible project with solid fundamentals, or are you just buying the story, the hype, and the marketing campaign? Because the investors who really win in this market aren't the fastest ones. They're the most disciplined. They understand that there will always be another project launch, but there won't always be real value. Everything else is just noise. And your capital deserves a whole lot better than noise.